Okay, Bismillah ar-Rahman ar-Rahim. Assalamu alaikum and good day, good afternoon. My name is Mohammed Masroua. I am currently an MSc student at INCEIF and at the third semester. So on behalf of the organization committee, I would like to welcome everyone to our third INCEIF Research Sharing Series. Thank you for joining us in today's session. So just let's have a quick reminder to begin. I hope that everyone is muted for the microphone so we can avoid anything. If you have questions to ask, please type them in the chat box. We will have a question and answer session later on at the end of the presentation. I will read out the questions to our speakers. Okay, so as an introduction, INCEIF Knowledge Management Center is organizing INCEIF Research Sharing Series to promote publication by faculty members to research and academic work. The first and second session of this series was conducted in September and November 2021, featuring INCEIF faculty members, Associate Professor Dr. Magda Ismail Abdul Mohsin and Professor Dr. Saiful Azhar Rusli. For today's session, we have invited Assistant Professor Dr. Kinan Salim to share on the journal article he has wrote entitled Switching Cost and Bank Competition, Evidence from Dual Banking Economies. Before I invite our speaker, let me share with you our speaker background. Dr. Kinan Salim is an assistant professor at INCEIF. He has been engaged in a variety of projects and provided services to leading institutions in finance and Islamic finance. Early in his career, he served as a head of corporate finance in Sham Islamic Bank in Syria. Prior to his PhD, he obtained a master's degree in Islamic finance from INCEIF, a master in banking and financial services from the Arab Academy for Banking and Financial Science, a diploma postgraduate in finance, financial and monetary economics, and a bachelor degree in economics. Dr. Kinan leads the Islamic digital economy at INCEIF, where he works with the stakeholders in Islamic fintech ecosystem to advocate Islamic fintechs. He specialized in Islamic finance, fintech, and sustainable finance. His research and consultancy focusing on designing frameworks and provide capacity building for innovative policies and products for Islamic fintechs, sustainable finance, and financial inclusion. So now let's welcome our speaker, Assistant Professor Dr. Kinan Salim, to share about the journal article, Switching Cost and Bank Competition, Evidence from the Dual Banking Economies. Dr. Kinan, the floor is yours.
بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على سيدنا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله تعالى وبركاته. Thank you very much, Brother Misrua, and thank you very much for KMC Knowledge Management Center for organizing and arranging this important session on sharing the thoughts and the research work that done by INCEIF faculties and INCEIF students. I'm very honored to be among the participants today to share with them some of the research work that we have worked on INCEIF and also to get their feedback and engagement. I believe those kind of sharing session is important because it brings together the like-minded people who are working on research for Islamic finance and Islamic banking. And this kind of meetings actually, it nurture more thoughts and more ideas towards research in the future where we can collaborate together to push the frontier of the research in Islamic banking and finance, especially while we are in the COVID time, still in the COVID era, where face-to-face physical meetings are still very limited. So those kind of online sessions, online engaging session with all the participants actually are very very crucial for the development and the enhancement of the research in Islamic banking and finance. So I would like to thank again all the organizing committees and the member behind this work. Today I will share with you some one of the papers that we work on the competition in Islamic banking. And while you allow me to share the slides, let me just give you some background about this area of research. Actually, there are many research have been done, or maybe few or many research have been done in INCEIF, working on the competition in Islamic banking and finance. Many PhD theses have been written on this, published journal papers on the topic, on the different angles of competition. And because we believe that this is one of the area that is very important for Islamic banking, to be competitive and to be in par or maybe better competitive than conventional banks, and also to be competitive among themselves, because we believe that competition will deliver, I would say, better, more quality products for the customers of Islamic banks, and also will provide them with a less price, less cost for their financial services. So in general, I would say from a customer perspective, a healthy competition environment is very important for the customers of Islamic banks. However, we know that competition may have different, I would say, aspects to be researched, like how the competition may affect the profitability of the banks, how it may affect the efficiency of the banks, how it may affect the stability of the banks. And all this research have been done in INCEIF, and many research papers have been produced in INCEIF. Now, within this competition theme in Islamic banks, and especially in dual banking system, where we know that we have Islamic and conventional banks, within this theme, we try to get one more step to see what is affecting actually the competition in the dual banking system. What are the factors that play the role in determining the competition? And we focus on one of a very specific factor, which is the switching cost. The switching cost from Islamic to Islamic banks, or from Islamic to conventional, or from conventional to Islamic, or from conventional to conventional. And why we get this focus on this aspect? Basically, the main idea that some of the research and some of the theoretical work that has been done, in general, it shows that the cost of switching from bank to bank, it can play a very crucial role in the healthy competition in the market. If the customers, for example, are captive within specific banks, within maybe, let's say, the old banks or the big banks in the market, and they are not able, or it's costly for them to move or to change to other banks, so they will get less benefit from the new entrants. For the new entrants, it will be highly difficult for them, big difficulty for them to attract those customers, even though they may provide better products with higher quality, with less price. But because of the high switching cost for the customers from their current banks to the new banks, they are not able to compete with the incumbent banks in the market. And that is important for Islamic banks, because in general, we know that most of Islamic banks, they are working in dual banking system, and most of these systems, the conventional banks have been there in the market for the last maybe 30, 40, maybe 100 years, and now new Islamic banks or Islamic banks coming to these markets. So we need to have this kind of healthy competition environment in this market, and switching cost can be a determinant factor in this healthy competition. The other aspect, when you talk about the competition in Islamic banks and the switching cost, that some researchers believe that because Islamic banks provide Sharia compliant solutions, and because there are some of the customer base, or maybe majority, minority, we don't know, but there are a big portion of the customer base of Islamic banks, they going for Islamic banks because they are Islamic. So regardless of the price or of the cost, they want to come to Islamic banks because they are Islamic, because they are Sharia compliant. So there was the idea that if you are able to get the customer, regardless of the price or the cost that you are charging them, then somehow those customers, they are captive with Islamic banks. So the switching cost from Islamic banks to conventional banks will be high. And because of this, maybe the competition or the competitive environment for Islamic banks are, I would say, less compared with the conventional banks, meaning that Islamic banks are less competitive because anyway, they are able to captive or to keep their customers. So those are the thoughts that actually inspire us to go further in this topic and to investigate. Is it really the case that the switching cost in Islamic banks are maybe higher than the switching cost of conventional banks, or the vice versa? And in both cases, in both situations, how this switching cost may affect the competition in the environment of dual banking system. Does it increase? Does it really affect the competition, or there's no significant impact on the competition? And from that, we are trying to see what are the consequences, or what are the recommendations that we can come with to solve or to address this issue. So these are the background on this research. And as I mentioned, we start with many research on the competition. And when it's come to this specific research, the switching cost, one of our brilliant students, Sister Siti Khulaifa, worked on this as her master thesis. Then we further enhance the work on this, and we try to collaborate also with our colleague from INCEIF, Dr. Lutfi. He's now in Brunei, and also from a colleague from other university, Dr. Mustafa. And then we sent this, we work on this maybe a paper for 1 year, and Alhamdulillah, finally it accepted and published it in one of the best journals. So this is a background about the topic. And let me now try to start the presentation and share my slides, get more details about the research itself, and what is exactly happening when we talk about the switching cost, and then how it affects the competition. What are the main recommendations that we come up from this study? Can you see my slides?
Yes.
Can you see the slides? Okay,
yes.
Great.
Yes.
Okay. So theoretically, there is a strong theoretical foundation that demonstrating that the cost of switching from bank to bank is one of the main barriers when you talk about healthy level of competition. And this is where we want to go deeply to see this one, especially with those claims that switching cost can be more prevalent in Islamic banks because of the Sharia dimension, because of the customers, they want Sharia compliant and they don't want to switch to non-Sharia compliant banking. And as I said, that's more interested when we talking about dual banking system, because this is where you have both Islamic and conventional banks, and you have customers coming from different backgrounds, have different motivation to deal with these banks. So here we are talking about the customers who have, let's say they are value or faith-based customers. They want only Islamic. And also you have the customers, they are neutral from the religion perspective. That means they are looking more on the quality of the services, on the prices. They don't bother about whether it is Sharia compliant or non-Sharia compliant. So we have the market in general, they have this two kinds of, I would say, generally two kinds of customers. And the research have been done before on the switching cost. Actually, it shows that when you have like a high switching cost, so it is a condition, or it creates a kind of monopoly in the market. And that is not necessarily, I would say, it's not necessarily related to the number of banks in the market. You may have 10, 20, 30 banks, but still, even though there are 30 banks in the market, but there is 1, 2, or 3 banks, maybe they are dominate, they are manipulate the market. And one of the main reasons for this manipulation, actually, it can be the high switching cost for the customer from those banks to other banks, because high switching cost, actually, it is discourage the customer to move to other banks. And when we talk about switching cost, they are, I would say, you can see it from different perspective. There is, for example, I want to change my bank. I want to go for other banks totally. So I move all my transactions from this bank. I'm talking about deposit, loans, transfer, with paying bills, or everything. I transfer to the new banks. Or sometimes it's not necessary for all the services that the bank provides. It may mainly focus on few services. For example, the loan. I'm getting financing from this bank, and now I want to move this loan or this financing from this bank to another bank. So it can be for the old products, or it can be for a specific kind of products. Now, when it comes to the a new entrant to the market, of course, they want to offer the new their new offering, their new product. They may offer it with the less price, with high quality, but then when you have, and this is what the previous studies shows, that when you have high switching cost, even though you provide this benefit for the customers, but the customers still are not able or not willing to go to your bank, because they are captive with their old bank, because the cost of switching is high. For example, you get a loan for that bank, so to switch that loan to the new bank, you may need to pay a lot of fees. There may be a lot of bureaucratic there, right? And maybe one of the main, actually, very like aspect for switching cost, that the bank that you are dealing with for the last 10 years, for example, they know everything about you. They know all your data. You have data transaction with 10 years. The new banks, they don't have this information, and you are not able to share this information with the new bank. So the old bank able to charge you less because they have this information, and the new banks, they don't have information, so they cannot really give a better decision for that one. So this is one of the aspects for the switching cost. Some of the studies also, they are going, I would say, more detailed. So they would see, they are comparing switching cost and competition among different kind of banks. Like this paper from Ears and Well, they try to compare the switching cost and competition. They try to compare between the cooperative banks, you know, the cooperative banks where the clients of the banks, actually, there's this client-based ownership structure where the clients, the community, they own the bank, actually. So they want to see if there is a difference in switching cost and competition between those cooperative bank and the normal commercial, or say conventional or commercial banks. And the idea for that research, that because maybe you are, for example, in this cooperative, maybe the managers, they don't have that incentives to lock in the customers, so they are neutral. So, but in the conventional banks, they have the incentives, because the more you lock in the customer, that means the more profit you can make, and you have actually this, I would say, incentive to lock in your customer, to have high switching power, to prevent your competitor from getting your customer. So they work on this research, comparing cooperative banks with conventional banks in this situation. And what they find, actually, they find that there is there's a significant positive relationship with the market power in both commercial and cooperative banks. Of course, when you talk about market power, so this is a proxy for competition. The more market power the bank has, actually, the less competition the market. Market power means that the bank actually is able to charge more than the marginal cost they have. So the more you are able to, for example, your marginal cost is this amount, you are, let's say 30, you are able to charge 50, 60, 70. So the more you are able to charge, that means the more market power that you have. So this is showing that the more market power, that means competition in the market is less. Other studies also, they have documented that the switching costs are positively associated with the market concentration. The more switching costs, actually increasing the concentration in the market. So I would say most of the previous studies shows that switching cost is determinant for the competition in the market. The more switching costs you have, the less healthy competition in the market. And that's actually aspire us to go and investigate more. Is this the case also in dual banking system? Because we have now a different setup. You have conventional, you have Islamic. We know we have also different setup regarding the customer segmentation. You have those faith-based customers, you have those neutral customers, right? So within this environment, within this like dual banking system, what is the case? Now, one of the main questions when we start to do the research is, do Islamic banks and conventional banks operate in the same market or not? And why? What does it mean, the same market? Of course, we know that, for example, Malaysia, Saudi, UAE, Kuwait, this is dual banking system, so they are there in the country. But here, when you talk about the same market, we talk about, let's say, the customers, meaning that is the customers of these Islamic banks are the same of the conventional banks? Are they targeting the same customer base? Or they are, each one, they have their own market, right? Like, for example, investment banks, they have different market than Islamic banks. They have different market than Takaful, right? So this is different market. But when it comes to Islamic and conventional banks, are they in the same market or not? Now, ideal Islamic banks are, I would say, profit and loss sharing, right? So we talk about the concepts of mudaraba, the concept of musharaka, for example, right? So when we talk about conventional banks, this is more on debt based. So it's more on like risk transfer. It's not about risk sharing, right? So ideally, Islamic banks, they are, from theoretical perspective, they are more on the profit and loss sharing, right? And also one of the main axiom for the Islamic banks and economy is that all the transactions should be backed by real economic transaction, right? Which is not the case for the conventional banks. It can be, in the conventional banks, it can be backed by real economic transaction or just like by financial instruments or something like this, right? So this is the ideal situation. So the ideal situation telling us that, yeah, there is maybe they are working in different markets. You are targeting profit loss sharing, you are targeting real economic transaction. For Islamic banks, for conventional banks, this is not the case. They are more on the risk transfer debt based, right? Now, this is the ideal. Now, in practice, Islamic banks have been in practice for the last 30 or 40 years, right? And what happened that, well, this is what the scholars think, the scholars, the practitioners, what happened that that the Sharia scholars and the bankers, the Islamic bankers, have developed Sharia compliant products that resemble the conventional banking products. They are Sharia compliant, but I would say the end result of the product, it ends up with a debt-based instrument, right? So it's not a profit loss sharing; it's more on debt-based instrument. This is from the practical view. Also, several studies that have indicated that there is actually no market difference between the conventional and Islamic banking business model. So the business model is almost the same. Still, we are saying here that Islamic banks are Sharia compliant, while conventional banks are not Sharia compliant. But then when it comes to the business model, getting the deposit, being financial intermediary, giving the financing, the business model is almost the same. And also, this is more emphasized by looking at the co-movement of the rate of return in Islamic banks and the interest rate in the conventional banks. So there is kind of a co-movement. They are very close, the ups and downs on this rate of return and interest rate, right? Here we are not like analyzing why this is happening, but we are looking at if they are really working in the same market or these are different markets. So all these studies showing that they are actually working in the same market, targeting the same segments of customers. And of course, there are this argument that why this happened, why this is divergence from the idea to the practice, because of the dual banking system, because of Islamic banks working in the dual banking system and the environment in such an environment. So Islamic banks have been like, I would say, pushed or like this grow to this kind of product. At the same time, because we are talking about also like this switch cost. There's a interesting paper from Al Jamal in 2006 where he argues that the fear of receiving interest return from the intermediary, it actually makes the Islamic bank customer captive to the Islamic bank. So he emphasized on this point that the Islamic bank's customer are captive to the Islamic bank. So meaning that Islamic banks have higher switching costs. They are able to capture the customers because the customers, they don't want to get interest. They don't want to move to conventional banks, even though maybe some conventional banks provide better services or less costly services, but they want to stay with the Islamic bank. So this point of view emphasize the idea that maybe the Islamic bank's customers are really captive in the Islamic banks, and the Islamic banks have higher switching costs. So this is also it make us like really to go deeply in this one. However, there are also some studies. They show that empirical studies. They show that Islamic banks actually don't have more market power than their conventional counterparts. Meaning that if you think that Islamic banks have higher switching costs, that should be reflected in the market power of Islamic banks. So in that case, we will see that Islamic banks have higher market power comparing to conventional banks. But then the empirical studies showing that this is not the case. The case that Islamic banks doesn't have that higher market power than the conventional banks. So maybe maybe this idea about switching costs are not really there. So this is some studies that previous studies that work. They are not focusing directly on the switching cost and impact on market power, but they are working in this area about the captive of the Islamic bank customers, the market power comparing to conventional banks. So with this study background, our main objective of this study actually was to investigate whether there are really significant differences in the switching cost in dual banking system, where we have both Islamic and conventional banks coexist and cooperate. So we wanted first to examine the degree of switching cost of Islamic banks that operate according to Sharia compliant with Sharia law. And then after getting the degree of switching cost and comparing it with the conventional banks, we want to examine empirically whether this degree of switching cost really can affect or explains the difference in the bank competition in the dual banking system. So summarizing, this is I would say the main objectives of this study. The data and methodology, just go quickly on this. We collect the data from 378 banks in 10 countries from 2008 to 2018. Of course, conventional data is much bigger. So we have like 290 conventional banks and 87 Islamic banks. The main data that we collect is that the bank-specific data. So we talk about the bank size, the income structure, the bank risk, capitalization, and inefficiency of the banks. First, we calculate the switching cost, and there is a specific, a little bit complicated methodology to calculate or to estimate the switching cost of the banks, which is the extended two-period model of Klemperer. And then after calculating the switching cost of the bank, we also calculate the market power of the bank. There's also like an estimation for the market power in the bank. And then we have our baseline model, where the dependent variable is the market power of the bank, which proxy or reflecting the bank competition. And the main focal variable is the switching cost. And then we have the other control variable, which is mainly the bank specific variables. And also we control for the time effect and for the country effect. Now, this is the descriptive statistic. You look at the market power now per country, you see that among the countries where, of course, these countries there are, this is where the Islamic banks, they have a high market penetration compared to other countries. But among these countries, you see that the market power are more in countries like UAE, Qatar, Saudi, and Kuwait. So this is the GCC countries. So you see that in the GCC countries, there are, I would say, the banks have more market power comparing with with other countries. Maybe one aspect, maybe because of the switching cost, but of course there are other aspects why you may have higher market power. Sometimes because you have a few banks, you don't have like a lot of banks. So some of these countries, they have only, for example, like a few 5 or 7 banks, while other countries, they have 30, 40 banks. So this can be one of the reasons. But what we try to see here that there is a differences among the countries when it comes to the market power. And in generally, you look at also the trend. So it seems that the market power in general, it's like a little bit increasing through the years. Now, we start with the main result, which is comparing the switching cost in the Islamic banks compared with the conventional banks. So we find that on average, that the switching cost in conventional banks actually is higher than the switching cost in Islamic banks. So that was interesting for us, and that shows that maybe the claims that the Islamic bank customers are captive to their banks are not really from empirical perspective. Need to be more investigated. So from our perspective, from the data that we have, it shows that in general the switching costs in Islamic banks are less than the switching cost in the conventional banks. That's also this. For the switching cost for loans, so as I mentioned at the beginning, you can say it from all the perspective, the products of the banks, or you can focus on the one aspect, which is the loan. So from both aspects, we find that actually the conventional banks, they have more switching cost on the customer compared to the Islamic banks. But that's the average for all the years, for all the countries. Now, we want to go actually more deeply on this, because we know that this differences maybe can vary among the countries and among the year. So we try to see by years the differences, and we see that the differences have been in all the years from 2008 to 2018. And while in the beginning it is, I would say these differences have been higher in the 2008, maybe in the global financial crisis, but then it decreases over the time. So one of the reasons why this happened, that as I mentioned in the beginning, maybe because the market was, I would say, dominated by the conventional banks, and then the Islamic banks come to the market. So the conventional banks, they have the more actually ability to captive their customers, because the Islamic banks were new in the market. But then over the years, when you have more Islamic banks, they are more established. This switching cost have been the difference in switching cost between conventional and Islamic has been decreases. When it goes country-wise, we found that there are differences in the countries. So we see that, like for example, switching costs in Bahrain and Malaysia for Islamic banks are higher than conventional banks. All right, so that's like that's interesting, observation for us. And while there's, I would say, for other countries, it is not the same. So what I'm trying to say here, that yes, on average, maybe conventional are more than Islamic with the switching cost for the customers, but this differences actually varies among the countries. And one of the reasons can be because different countries, they have different frameworks for Islamic banks, different level of maturity, I would say, for Islamic banks and support for Islamic banks in those countries. Then we try to get more deeply to see how the switching cost may affect the competition in the market, may affect the market power in the market, which is one of the main aspects for this studies. Basically, what we find that similar, I would say, to most of the previous studies, that there is a positive and significant relationship between the switching cost and the market power. The higher the cost of switching, the higher the market power of of the bank. And we find this is both for Islamic and for the conventional banks. Then we try to see that, we try to interact with the Islamic bank dummy to see that whether this relationship between cost of switching and the market power is higher for Islamic bank or less for Islamic banks. So we interact with the dummy variable of Islamic banks, and we find that the impact of switching costs on the market power for Islamic banks actually is higher, statistically higher than it for the conventional banks. So again, in general that we find that the switching costs have a positive impact on the market power on the banks, and then this impact is higher in the case of Islamic banks, meaning that if Islamic banks have a higher switching cost, that reflected in a higher actually impact on their market power, and it reflects on higher impact on the competition in the Islamic banks and in the conventional banks. So this is in a nutshell the results that we have find, and we try to understand why this difference is happening. Why in Islamic banks actually they have this more impact of switching costs on their market, on their market competition or market power. But one of the aspects that we believe that this may be the reason for this difference is that the customer base or the customer segment in the market. So again, if you look at the market, in the dual banking system, you have those two kind of customers: the customers that they are driven by their Islamic values and they only want to deal with Islamic banks. On the other hand, also you have the customers that are they don't make their banking decision based on their religious value. They make their banking decision based on the price, on the cost, on the quality of the products or the services, right? So you have these two kind of customers. Now, for Islamic banks, the customers of Islamic banks actually are both those who are Sharia-driven customers and those who are coming to Islamic banks because they provide better services, right? So when you have a higher switching cost for those who are Sharia-driven customers, when they switch the bank, they only switch from Islamic to Islamic. They don't switch to conventional banks, right? So that increase actually the market power of the Islamic banks because of this base of the value-driven, or I would say Sharia-driven, religious-driven customers, right? On the other hand, you have those non-Sharia-driven customers, and those customers, when they switch the bank, they may switch from Islamic to conventional, or they may switch from Islamic to Islamic. It depends on what is the offer from the other banks. So they are not looking about whether the other bank is Islamic or not, but they are looking more on the offer of that bank. Now compare this with the customers or the customer base of the conventional banks. The customer base of the conventional banks are the non-Sharia-driven customers. So when they switch, they may switch for Islamic banks or they may switch for conventional banks. They don't have any preference to switch for Islamic banks because they are non-Sharia driven. So when they face this high switching cost, even when they try to change, they are neutral in changing. While you see at the Islamic banks, you have these two kind of customers. Some of them, they are neutral in changing to Islamic or conventional, but some of them still captive for Islamic banks. And we believe that maybe this is the reason why the impact of switching cost on the market power is higher in Islamic banks compared to the conventional banks. These results have been like we try to test different kind of models. We use alternative proxies for the competition. We use also alternative proxies for the switching cost, and almost the results were identical or very similar in confirming this result. Now, out of this result, we try to see what kind of solutions or recommendations that we can provide to maybe to the regulator. And mainly we're looking at this, the main result that we find that switching cost is affecting the competition in the market. So we need actually to decrease the cost of switching. That's I would say this is the main thing, that to have a healthy competition environment in the dual banking system, we need to decrease the level, or we need to decrease the cost of switching the banks, which is better for giving better opportunities and the services, high quality and less cost services for the customers. Now, there are of course different ways to reduce the switching cost. And as I mentioned here, that here we are not talking about a specific countries, we are talking about 10 countries here based on the study. So some of this recommendation may already applied in some countries, but it can be applied in the other countries. Like, for example, having a centralized credit bureau where all the banks can share their customer information and credit history, share among themselves. So when to have better prediction model for their the model of the probability of default. So having a centralized credit bureau. Also pushing the banks or obligating the banks to grant the customer their credit reporting and data. And that's very important aspects. As I mentioned, one of the main aspect of switching cost, because the old bank, or you are dealing with the banks for the last 10, 20 years, so the banks, they have a lot of your data. But again, this is your data, this is not the bank data. So you should be able as a customer to share this data with other banks. So you will get more offer from other banks. But because the bank have this data and you are not able to access and share it with other banks, so you are captive. Your switching cost is higher actually. So, and this angle have been observed actually by some countries, like in EU, for example, they push for the open banking and open API, where the customers, they have the access for all their data and they are able to share this data with other financial services provider in order to get better services from those providers. Of course, initiating a shared credit scoring model tools for all the banks, enforcing maximum time frame to process customers' request to switch the bank. For example, I want to switch from this bank to that bank, but because of the administrative, bureaucratic cost in monetary wise, in time wise as well, I just give up and say, okay, I will not change. So we need to find a mechanism, maybe the regulator can do it, to have a maximum time framework, minimizing the administrative cost for this one, setting a limit for on the cost of closing a new account or opening a new account, minimizing the penalty for loan transfer. You know that in some banks they put such kind of conditions or penalty if you want to transfer the loan for other banks, for example. So the higher that you put this penalty, actually you are captive your customer. So we need to find a mechanism to minimize this penalty. Of course, sharing the facility, ATM facility or other facility that help the customers to benefit from the networking, the banking networking, free of charge transaction across the bank. So those are some of the solutions or mechanisms that reducing the switching cost. But the main idea here again is about actually how to reduce that switching cost, because in the end of the day, that will be beneficial for the customer. Now, someone may ask, is this in the benefits of the banks or not? Now, of course, those banks who have, let's say, who already captured their customers, already have high switching costs. But then the banks who are have less switching costs, or they are, for example, the new entrants to the markets, they are welcoming this kind of recommendations. But in the end of the day, we are not just looking from the bank perspective, we are more looking from the customer perspectives, because we believe that in the end of the day, it is the customer who should be served better. It is the customer who should be like having the better quality, the better services, the better financial services, the less costly financial services. And it is the regulator, I would say, the regulator responsibility trying to provide this kind of environment that supporting and helping the customer in general. Okay, so this is I would say a summary of the results of this studies. Of course, there are a lot or there are like limitations when it comes to this study, similar to other studies. Like, for example, you can say some of the limitations regarding the calculating of the market power or the quality of switching cost. Is it can we calculate, for example, switching cost for all the services? Is it reasonable, or we need to go more details in each aspect or in each services for that one? One of the aspects that because we aggregate data from many countries, so we're looking from aggregate perspective. Even though that we try to control for the country effect, but maybe further research can be done trying to focus on specific countries. Like, for example, we want to see this specifically in Malaysia, or want to see this specifically in Kuwait, for example. So this is actually like a recommendation for future studies. One of the main, I would say, a limitation and future also opportunity for research is the new digital banks and fintech services, because this digital bank and service and fintech services, they provide a different, I would say, customer experience, and they claim that they are able to reduce the cost. So how this may affect, so the switching cost, for example, from incumbent banks to digital banks, how it will be, how the competition between fintech or digital banks and incumbent banks will be. So those kind of, I would say, future research that can be done and that can be investigated in this theme of banking competition and switching cost. So that's all about the research, and I'll be happy to receive and to like discuss with all the audience about their feedback, how we can go forward from this. What do you think about the competition, the switching cost? Yes, so this is just an open session for discussion, and thank you very much.
Thank you, Dr. Kinan, for the presentation. It was very detailed explanation given by you on this article. So now we will begin answering. If there is any questions, please post on the chat box so I can read the questions to Dr. Kinan, or maybe if any participation too.
By the way, you can ask me also. Ask my co-author, which is already here, Sister Siti Khulaifa. So we both will be welcoming any question. Of course, the questions can be, if you want, like about the study itself. Also, if you are, this is for our PhD students and master students, if you are interested to go further or in this kind of studies, if you are looking at the topic in this area, also we can discuss it, how we can enhance the research in this area specifically.
I guess your presentation was too much detailed. Too good for questions.
Okay. Alhamdulillah, alhamdulillah.
Maybe I have a question in this case.
Yes, please.
What do you think the introduction of new technologies such as platforms on blockchains and will impact this capacity of changing from a provider to another provider? Because we potentially will have online such an online banks on those systems, and so everything will be decentralized. So
yeah, but that's a very, very interesting question. Actually, it's not just about I would say it's not just about the blockchain itself, but it's also about the fintech company, how the presence and how what they call the disruption of a fintech company may affect the financial landscape. And this is very interesting because fintech company, they claim that, or the proponent of fintech company, they claim that this is a disruptive solutions. So it will totally change the landscape of the financial services or the financial provider. Now, what happened? Let's discuss, or let's see what's happened actually. Fintech providers come in, they provide a good solution, better customer experience, I would say. And they've been able to provide better customer experience for the reason that they basically coming from this background. So basically these are, let's talk about, for example, Microsoft, Facebook, LinkedIn, those companies. Those companies, their main mandate actually is to provide better customer experience. So this is the main thing they are providing, the better customer experience, right? So when they come to the fintech, when they come to the financial services, this is their main actually mandate. They are able to provide better customer experience, and this is what they did. And because also they have the cost structure that they have, they don't need, for example, to have branches. They don't need to have a lot of stuff, because they are able to provide algorithms, for example, to automation and algorithms to do the banking task. So they are able to get it in less cost. So in the beginning, this is the case. So they are able actually to disrupt. They provide better experience with less price. Now, of course, the financial institution, the banks, they see that, and they will not just like sit down and watch what's happening. So they also say, why we are able also to provide good services. We are able to digitalize, and you are able to go online and provide this digital experience, and with a different strategy actually to do so. So some of the banks, they collaborate with some of these tech companies to provide this experience. Some of them, they do it internally. They do the digital transformation internally. Some of the banks, they look at those companies. For example, this is a good fintech company, provide good customer experience, so they acquire this company. They invest, they acquire this company, and now they are able to provide the same experience, the same customer experience with this company. So banks in general, financial service provider, they adapt to this changing in the market, and they compete with this. Now, from customer perspective, that's good. Now I have a fintech company. They provide me good, cheap and good services, financial services. And also now the banks, the incumbent banks, because of this competition coming in, they are also providing better experience with less price. And let's say this start with high net worth customers, with the middle class. And now the good thing it goes for the let's say for the B40, for the bottom I would say customer segment. Those customer segment where in general they were, I would not say neglected, but this is not the priority of the banks. The banks were more focused on the high net worth and the middle class. But because of this competition, now the banks, the fintech companies, they are looking for this customer base, and they are providing the services for this customer base. So what we see practically that this changing in the market is helpful for the customers, provide them with a better services with less cost, I would say, product. This is observation, right? But this is a very good opportunity for the researchers to confirm this observation, whether these observations are right or wrong. The challenge here actually is about the data, because when we do study on the banking, we are fortunate that we have the data sources. We get it from Fitch Connect, for example, we get from Bloomberg, from Thomson Reuters. So we are lucky that we have these data sources. We can do a study on the banking. When it comes to the fintech, because they are new, the structure of their data are new. Some of them, they are just like there for 1 or 2 or 3 years. So they don't have the data, or they don't publish the data yet. So it's somehow challenging for the researcher to collect the data. So maybe the researcher need to do a study where she collect the data by themselves, doing a survey, for example, or trying to get the other data sources to get this data. So this is a challenge for the researcher, but at the same time, this is opportunity, because it means that not every researcher is able to get this data and do their research. So for those researchers who have the ability, the right skills to collect the data, and the good time frame, for example, they do their master thesis, PhD, so they have a good time frame to work hard on this, they will be able to produce good and unique research papers, thesis, in the topics that it's a hot topic, and I would say not everyone is able actually to do those kind of research.
Okay, thank you. Thank you for the response. I think the Sister Azrina has a question here in the chat.
Sorry, thank you. Sorry, I just jumped in. I came in very late. So basically, this paper is more on a research covering the switching costs. I assume it's covering both the banking perspective, as in they will move away from a traditional or conventional way how they used to operate to become much more digitally savvy, is it? I mean, it is, and also to also cover in terms of the customer's point, where are they able to basically benefit more from the digital setup? Is that what the research would cover as well?
Okay, this is for the future research.
Oh, okay.
So
sorry. Okay.
The research is cover this switching cost and the market competition between Islamic and conventional banks. But we are talking about like a few opportunities for future research. So this is where we see that the digital banking, the fintech, the competition. But by the way, I mean, this is by itself, this is a good topic to study. Even don't look at the switching cost. You may just look at the competition itself. Then the landscape of competition within this new era of digitalization is really because we have this new fintech companies, because of the digitalization, is it really we are getting more competition in the market, or maybe not? This is the case. Maybe we see it, but if you go to the data, try to investigate, maybe this is not the case. So this is one of the opportunity for future research. As I said, the researcher will face some challenges regarding collecting the data, not just collecting the data itself, but also because you have a different structure or aspect of data. Like, for example, when you compare Islamic and conventional banks, you look at it, somehow you can compare. So there's a deposit here, there's deposit there. There is a total size here, bank size, asset size, there's asset size there. Efficiency here, efficiency there. When you look at and then the Islamic banks, they provide like this set of products, the conventional provide this sets of products. So somehow you can compare. Now, when you bring fintech company, it will be a little bit more difficult, because this, for example, crowdfunding company, they are only specialized in crowdfunding. They don't have current account, saving account, they don't have bank transfer. So all those other services, they are not there. So you need to compare that aspect with a similar aspect in the banks. So those are some of the challenges. But again, actually, those kind of challenges what make the research is more valuable and more interesting area for the researchers to try to navigate and to work on.
Agree. The part that you mentioned about getting the data points, especially from the fintech companies, that is quite difficult to quantify. But I do think that when it comes to Malaysia's digital bank license, one of the conditions is to have the need for them to make sure the market segmentation is towards the unserved and underserved segments. So I would find it very interesting if there is a research being done in terms of how they manage to basically serve and make it attractive enough that even compels the conventional bank or Islamic banks to also crowd into serving this kind of clients.
Yeah, you raise a very interesting point. So when the regulation in Malaysia come to digital banks, they put this condition or this aspect that it should focus or it should show the value proposition that it served the underserved, for example, right? Or the non-served customer. And why this coming? If you look at the banking landscape in Malaysia for the last 20 years, there is this, I would say, actually there were this movement after the 1997 crisis. There were this movement to consolidate the banks, right? So it's more on consolidation on the banks, and some people, they look at the consolidation and the decreasing the number of the banks as less. That means less competition. So we need to have more resilient few banks in the market, better than having a lot of non-stable banks, something like this. So if you look at the landscape in the last 20 years, there are not many new banks in the market. You can look at it for the last 20 years. There are only maybe few cases where you have a new bank in the market, right? So now, because of the digitalization and because of the potential of the digitalization, the central bank want to allow for new banks. But the central bank looks like the market is the banks in the market, they are already serving. They are very well, they are very good, they are serving the market. So why I want to give a new license, digital bank license? There should be a reason for that one. And from the central bank perspective, that they say the reason for that one, I want to see the value proposition that you add, because the current banks in the market, they are able to digitalize actually. So if I want to give new license, I need to see this new value proposition, additional value that you are giving for the B40 or for the underserved or for the non-served, because this is the area where the regulator, also the scholar, this is the areas where they see that there is opportunities there, and there is a lack in the services provided in that one. So this is from the regulator perspective. But now, one thing that we need to later to keep eye on, and this is also good, the area for the researcher to look at later, to see that whether this kind of enforcement for the digital banks is healthy for their growth or not. Like, for example, digital banks right now established and come to the market, and it's competing with the incumbent banks. The digital banks can only focus or should focus on the B40 or should focus on the underserved. The incumbent banks can serve this segment and can serve the other segment in the market. So is this kind of, I would say, competition is fair, for example, or can the new digital banks survive with this condition in the market? So this is something interesting to see in the future. And I believe this experiment, or this like the new banks, the new digital banks, I think 5 licenses will be given. So it will be very interesting to see whether that they are able to success in this condition, and they are able to serve and be profitable within this specific segment. Of course, we are not talking about a small portion. When you say B40, that means 40% of the market. So it's by itself, it's a good portion, but it will be very interesting to see if they are really able to survive and to provide good services for them, and at the same time being profitable and being sustainable for those digital banks themselves. If this is successful, that would be very interesting, and something can be replicated also in other countries.
Thank you, Dr. Kinan. Any other question?
I think that there is a question about from Dr. Adnan about the measurement, how to measure the switching cost. As I mentioned, it's a little bit complicated calculation for measurement the switching cost. Basically, we use the extended 2-period models of Klemperer. This have been illustrated in the paper of Shai 2002. again, it's a little bit complicated. Maybe we need to have like another section on this. But it is doable. But the main thing is when we use this calculation for the switching cost, again, you can use it for the overall products of the banks, or you can focus or narrow down on, for example, switching cost for the deposits product, or switching cost for the loan products, or for the financing product. So you can like go more in details on this, and that will be helpful also for the future research. So you can choose one aspect specifically that will be helpful when you compare, or if you want like to study or do comparison between the banks and the fintech companies. For example, as I mentioned, like with crowdfunding maybe, or P2P, they are focusing on loan. So if you want to look at the switching cost, compare with the banks, so maybe you look at the loan switching cost of loan in the banks, not the overall. So what I mean, like narrow down the calculation for switching cost would be helpful to do further research comparing with fintech companies.
Okay, so nothing. So Dr. Kinan, in same context, then if there is no question, I am going to ask questions.
Yeah, please go ahead.
Okay, good. Since you have been talking about these digital banks, we know that conventional banks and Islamic banks have been set up initially as deposit-taking banks, and that's probably why they are not very interested in the BIP40s, because they need that cash to come in to work with it. If we move forward into new fintech models where the deposit is less important in the activity of the banks, then if the banks lowers its cost, then they need to come out with a new type to make it profitable. That's the only way to compete with the regular banking. What do you think?
Okay, so basically, if you look at the banks being conventional or Islamic, right now in the market, we see that they are a financial intermediary, right? So they are getting deposit, and they get financing. Of course, different banks they have more, I would say, like advantages or disadvantages in one of these two aspects. So you see some of the banks, they are very good or able to collect deposits. While some of the banks, they are better in give financing, right? And that's not just about the bank itself, but also if you break down on the branch level, you will see that some branches, they are more able to collect deposits, some branches they are more able to give financing, right? And this is where you have also the I would say the banking market, right, or the money market or the banking market, where the banks, they can actually take from each other, right? So those banks who are focusing on the financing, they can get from those banks who have more deposit. So I don't see this as I would say as a challenge. Now the challenge for the banks, conventional Islamic, when it comes to the B40 actually, is more on the risk profile of the B40 and the amount of profit that they can generate from this. Like I give this the simple example. For the banks, for example, if the banks have, let's say, if have 10 million ringgit or $10 million to give financing, has two choices. One, to give this 10 million to one, for example, wealthy or a businessman, or to give this 10 million to, let's say, to thousands of B40, right? Where each one of them, they have 10,000 ringgit. So you have two options. You get 10 million for one person, you have 10 million, you give 10 million for 1,000. Let's assume that you charge the same profit, right? Let's say you get like 5% for both. But what is the cost for that? In both cases, you need to do a study, you need to do the credit assessment, right? So it's much easier for the bank to focus on one customer. They can do the credit assessment, they can visit the customer, they can go very details in all the financial and non-financial aspects for that customer. But when you talk about 1,000 customer, it will be difficult for the bank. Even for visiting them, maybe the cost of visiting the customer will be more than the profit that they get from that customer, right? So because of that cost, the banks are not able actually to provide these small amounts of money at the same rate they are giving to the the high net worth or the, let's say, the middle class, right? Now, in order to solve this problem, we need to find other mechanism for the assessment of the customer. And this is actually where the alternative credit assessment models are coming in, meaning that you are not only depend on the historical data of the customer, but you can also tap on their psychometric data, their social media data. You can use machine learning, artificial intelligence algorithm for all this data they are providing in order to have a better prediction for their default. And once you have better prediction, and you are able actually to serve this, I would say, to serve this segment of the customers.
Right. Okay. So it's about providing ways to lower the risk for the banks.
Exactly. Exactly.
This portion of it. Okay. Okay. Any question, please? No questions so far. Okay. So we are 4:18. We have time to take one more question.
Dr. Kinan, Assalamualaikum.
Yes. Waalaikum assalam wa rahmatullahi wa barakatuh.
A newbie question for me. Are you using Python in your data cleaning?
Oh, okay, good. For this research, we used Stata for it. But of course, this is the data cleaning part can be done through using Stata, using Python, and other statistical software. We don't use Excel for that one because it will be actually very time consuming to use Excel for this data. So Stata is sufficient to do this research. Now, I would recommend using Python if, for example, if you apply machine learning algorithm. Of course, I will recommend to use Python. But for this research, we didn't need to go for machine learning. So we just use statistical methodology using OLS, which is like very efficient using Stata, and data cleaning, which is also very efficient using Stata. But if you have more, if you want to use machine learning, so I will recommend Python. And maybe in other, if you are working in the bank, for example, or if you have access for the daily data, for example, for the customers, then that would be kind of big data. So of course, in that case, also I recommend to use Python to clean that data.
Okay, thank you again.
Okay, so thank you very much. Thank you, Dr. Kinan. Thank you, the audience, for all your questions. Before we end the session, I would like to request all participants to switch their camera so we can take a quick photo, inshallah. Okay, Brother Hanif, are you taking care of the photo? You're muted, yes. Okay, so 1, 2, 3. Give us a good smile. Okay, maybe second page, right? Okay, good. Okay, good. Thank you very much. So that concludes the third INCEIF Research Sharing session. Thank you again, Assistant Professor Dr. Kinan Salim, for this great presentation, and thank you for the responses. It was a pleasure to have you with us today. Thank you to all our participants for joining. We hope you have learned and enjoyed this presentation. I would like to inform that the journal article, Switching Costs and Bank Competition, Evidence for the Dual Banking Economics, is accessible at INCEIF Knowledge Repository, IKR platform, for INCEIF staff and student, obviously, and INCEIF KMC subscribers. With that, thank you and have a pleasant week ahead, inshallah. Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh.
Thank you very much, and assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much.
Thank you, Dr. Kinan.